I think, and before going to the active or the passive side of investing, I think the role of alternative investing is now grown a lot more than it used to be, say, 10 years ago. If you ask anyone, maybe 20, 30 years ago, they would say, buy 30, 40 stocks and you're done with it. Because that's sort of enough for you to, for your investing needs. Then if you ask someone, say, 20 years ago, they'll say, I think buy a combination of debt and equity, where you're basically hedging your equity by having some debt in your portfolio, because obviously debt is a lot more stable. It lowers the volatility of your equity portfolio, and equity at times can go up also, but it can go down also. But obviously, for the long term, equity is done pretty well for most investors. So alternative investing is actually a third asset class, or at least a third theme, which I think is extremely important from an investor's point of view, because it sort of really leads to your portfolio becoming a lot more stable. What does that mean? Today, the biggest barrier to anyone who wants to invest for their future, and the reason why investing in the future is important is because, I think, and fundamentally, from what I have seen, it's very difficult for you to become wealthy by earning more at your job. That's impossible. There's almost no wealthy person in the planet who has become wealthy because of his salary or his or her salary. The only reason why they become wealthy is because they own equity, either in companies, in startups, or in their own companies, as sort of founding members. And which is why, obviously, investing is extremely important, because that's your sort of way to wealth. And that's the only way you can sort of earn while sleeping. But within investing itself, obviously looking at outside of traditional metrics like bonds and equity, I think the reason why I would really propagate, alternative investing is because it's, again, an uncorrelated asset class. So what does that mean? What that means is that, tomorrow, if the equity markets go down, then your investment should not be tied to it. Because if it is tied to it, then if equity markets go down by 30%, your entire portfolio will also go down by 30%. Or if debt markets fall by 20%, which has happened in the past, then your investment will go down by 20%. So which is why, I think I'm a big propagator of alternative investments, because it really hedges your portfolio from market-related risks. So today, if you look at, say, what of some of Pyse's offerings in sustainable investing, or if you're looking at, say, cryptocurrency, or if you're looking at real estate, or if you're looking at gold, these are all alternative asset classes which traditionally were not looked at as investing. But today, I feel that, they are quite investable. And overall, what it does, it sort of really, lowers the volatility of your portfolio and helps you invest for a much longer time. Because, if you're saying, say, last March, when the markets fell 20, 30%, people who are thinking of stopping their SIPs, not investing. And then today also people are thinking of stopping it because they think the markets are too expensive. This is where alternative investments come in. And ideally, you should really look at it, because on a comprehensive point of view, it really sort of de-risks you from some of the market-related risks that you see out there.